This isn't a rally, it's the fiat system hitting terminal speed. When gold breaks through $4,700 and silver pushes past 90, that's not optimism, that's abandonment. Investors aren't chasing returns anymore. They're running from paper that no longer feels safe to hold. This move isn't gradual, it's vertical. Real assets are doubling because trust in sovereign money is evaporating. And once that psychological line breaks, it doesn't come back quietly. Here's the part that should make you stop. Trillions of dollars in US debt are coming due, right as rates stay punishingly high and buyers disappear. The government can't refinance without expanding the money supply. And expanding the money supply means one thing: the currency absorbs the damage. If you're holding cash, this matters immediately. Because when gold and silver surge this fast, it's not that metals are suddenly worth more, it's that the unit measuring everything else is failing in real time. On the surface, markets still function, prices print, officials stay calm, systems appear intact, but underneath, confidence is collapsing. And once confidence goes, the reset doesn't ask for permission. What's accelerating this isn't speculation, it's a breakdown in the bond market, and the clearest warning signal is coming from Japan. For decades, Japan played a quiet but critical role in the global system. It exported capital, buying foreign bonds and helping keep global borrowing costs low. That flow acted like a stabilizer. But now Japan's own bond yields are surging to record levels. And when that happens, the money comes home. That repatriation drains liquidity from everywhere else, especially from the United States, right as it faces a massive refinancing wall. When one of the largest and most reliable buyers steps back, the consequences are immediate. Yields rise, prices fall, and suddenly US Treasuries don't look like a safe haven. They look like a risk. This is where the usual expectations fail. Rate cuts don't calm the market because the market isn't worried about growth. It's worried about solvency. Once that fear takes hold, monetary policy loses its grip. Here's the reframing most people miss. What happens when the asset meant to anchor the global system starts behaving like a liability? Because when that perception spreads, capital doesn't wait for confirmation. It moves first. The pressure doesn't stay contained in markets. It spills directly into geopolitics. The era of smooth globalization is over. What's replacing it is economic warfare, and currency is one of the weapons. The United States is signaling a shift away from protecting a strong dollar toward prioritizing domestic advantage, even if that weakens the currency's global role. That means reciprocal tariffs, barriers on European goods, and a willingness to make access to the US market more expensive for everyone else. This isn't theoretical. Specific tariff levels are being discussed, and countermeasures are already forming overseas. Once trade turns adversarial, alignment breaks fast. Central banks stop moving together. National interests override global stability. The system fragments. This is where the story flips. The dollar was never just money. It was infrastructure. It worked because everyone agreed to use it. But when policy starts penalizing participation instead of rewarding it, that agreement weakens. And when the anchor currency becomes a strategic tool instead of a neutral standard, foreign capital adapts. It diversifies, it exits, it looks for assets that don't depend on political permission. That's why metals aren't rising in isolation. They're rising as confidence in cooperation collapses. Because once globalization fractures, capital doesn't argue, it leaves. From there, the response shifts from trade to territory. When supply chains can't be trusted, access to raw materials stops being an economic issue and becomes a national security priority. And that's exactly how governments are behaving now. Not as neutral regulators, but as direct participants racing to lock down physical resources before someone else does. You can see it in the urgency, renewed interest in Greenland, executive orders opening vast mineral regions in Alaska, Projects that sat untouched for years suddenly get pushed forward. Gold, silver, and copper aren't being discussed as commodities anymore. They're being discussed as strategic necessities. This is the tell. Governments don't move toward direct investment in mining unless they believe the market can't deliver what's needed in time. When hundreds of billions are earmarked for extraction, it signals fear of future shortages, not confidence in abundance. And notice which materials get labeled critical: silver, copper, inputs for energy systems, electronics, and defense. Once a material enters that category, free market pricing takes a back seat. Control, stockpiling, and prioritization take over. This is how trade competition evolves into resource competition, and resource competition escalates faster than prices can warn. Because when states start hoarding, availability matters more than cost, and that's when the supply problem becomes impossible to ignore. The next fracture point sits inside the supply itself, and this is where price stops working as a solution. Silver doesn't respond to higher prices the way most people expect. Around 75% of global silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means supply is rigid. You can double the price and output barely moves because silver isn't what those mines are primarily chasing. At the same time, the pipeline is already strained. Ore grades are falling. New discoveries are rare. Projects that were shut down years ago can't simply be restarted. Bringing a new mine online takes close to a decade. There is no surge capacity waiting to flood the market. Now layer demand on top of that. Green energy systems, electric vehicles, grid expansion, defense hardware. Consumption keeps rising, but unlike gold, industrial silver is used and discarded. Once it's built into a panel, a circuit, or a weapon system, it's effectively gone. This creates a permanent imbalance. Prices rise, but supply doesn't catch up. That's the shift. This isn't a cycle that self-corrects. It locks in. And once buyers realize there's no mechanism to create new metal fast enough, behavior changes immediately. They stop waiting for pullbacks. They secure what they can while they still can. The stress finally surfaces where the system was always weakest. On paper, the silver market still looks orderly. Contracts trade, prices update, liquidity appears intact. But behind the screens, the behavior has changed in a way the system was never built to handle. Large players are no longer rolling contracts or settling in cash. They're demanding physical delivery. That shift alone breaks the math. In a single month, roughly 65 million ounces are pulled from exchange vaults, the largest delivery volume in decades. The structure of these markets assumes most participants never ask for metal. When that assumption fails, the leverage becomes visible, and the strain shows up immediately. Settlement times stretch into weeks. Inventories drain. Exchanges raise margin requirements, not to cool speculation, but to force weaker hands out. It's defensive. It's about protecting the clearing system. This is where confidence starts to wobble. Because once participants question whether the metal is actually there, paper claims lose authority. The price on a screen matters less than the ability to take possession. And when enough players reach that conclusion at the same time, the system faces a question it was never designed to answer. What happens if demands for delivery keep accelerating? The shift doesn't stop at exchanges. It moves across borders. The center of gravity for pricing is snapping from west to east. China and India aren't treating silver as a trade anymore. They're treating it as a strategic asset. Exports are restricted. Domestic production is retained. Banking systems begin absorbing silver into reserves instead of relying on Western price signals. This is where valuation fractures. Physical silver in Asian markets trades at a persistent premium over US spot prices. Not because of hype, but because delivery matters more than paper settlement. Two prices now exist for the same metal, one for contracts, one for possession. Here's the detail that changes everything. When a central bank begins valuing silver alongside gold for collateral purposes, silver stops behaving like an industrial input. It starts behaving like money. That single shift redefines demand permanently. And notice what can't fix this. Arbitrage. In a functional global market, price gaps close fast, but export controls, approvals, and physical bottlenecks prevent metal from moving freely. The gap holds. That tells you something fundamental has broken. The global silver market is no longer unified, it's regional, political, physical, and once pricing fragments like that, old reference prices lose authority, which raises the next question. What happens when strategic demand meets military necessity? At that point, silver stops being just an economic input and becomes a security asset. When governments label a material critical, it's an admission that failure to secure it threatens national defense. That label now applies to silver, not because of investment demand, but because modern military systems depend on it. Advanced electronics, guidance systems, missile technology, the quantities involved aren't symbolic and they aren't optional. Once a metal enters this category, normal market logic breaks down. Demand becomes price inelastic. Defense procurement doesn't wait for pullbacks or negotiate premiums. It buys what it needs when it needs it. And much of that buying doesn't show up in public data. Stockpiles grow quietly, supply drains invisibly. This is the part most people miss. Even at much higher prices, substitution isn't realistic. Alternatives are slower, inferior, or untested at scale. For systems that cannot fail, cost becomes irrelevant. So a floor forms under the market, not because of traders, because governments cannot tolerate shortages. And once that floor is in place, volatility shifts direction. Pullbacks get shallow, rallies accelerate, because when military demand enters a market that's already structurally short, scarcity stops being cyclical. It becomes permanent. Behind the scenes, the conversation shifts from markets to strategy. There's growing discussion around using higher metal prices as a stabilizing force rather than a side effect. Revaluing silver isn't framed as speculation, it's framed as a pressure release. Higher prices inflate balance sheets. They offset debt. They create breathing room inside a system that's running out of options. And unlike endless currency expansion, repricing a scarce physical asset feels deliberate. This is why specific price levels start circulating quietly, not as predictions but as thresholds, levels where industrial demand still functions, where collateral systems still work, where the system can rebalance without admitting failure. The objective isn't to make silver expensive, it's to make it useful again as an anchor. At the same time, the lines between institutions blur. Central banks move closer to treasuries. Independence gives way to coordination. Inflation is tolerated. Asset prices are allowed to rise. Stability gets redefined as avoiding collapse, not restoring the past. Timelines matter here. Policy shifts don't announce themselves early. They surface around events, deadlines, and shocks that force decisions. And once one country formalizes a new role for silver, others won't hesitate. They'll follow. What matters now isn't whether prices keep rising, it's what those prices are already telling you. They're signaling that trust in paper systems is breaking faster than policymakers can respond. That contracts, promises, and benchmarks only work when confidence holds. And once that confidence starts to fracture, capital doesn't debate, it migrates. This isn't how resets look in textbooks. There's no announcement, no clear starting gun. It happens through repricing, through delivery delays, through widening spreads, through the quiet shift from claims to possession. By the time it's obvious, the move is already mature. Most people will focus on the numbers and miss the message. They'll argue about whether gold is too high or silver has gone too far. But that's backward. These prices aren't excess, they're adjustment. The real divide won't be between winners and losers. It will be between those who recognize the structural shift early and those who waited for confirmation that only comes after access tightens and options narrow, because when the system finishes resetting, it won't reward speed. It will reward position. If you want to keep tracking where this is heading and what pressure point comes next, follow for continued analysis.